Welcome to Option Trades Today. I'm Tony the Baptiste, and I've got a trade idea for you today in an ETF. We're looking at March 21st, the day after, well, second day of spring, but it's still 35 or 40 degrees here in Chicago, but hopefully it'll warm up soon. All right, what's going on with the market? Because the market's warming up a little bit here. Even the S&Ps, if you're taking a look, are up 37 handles right now. That's 37 points. When I say handles, I just mean points. NASDAQ is up 77. I keep my percentage change for all of the ETFs and futures that I look at on the left side of my platform because it gives me an idea. If you're taking a look at this, you can see that, you know what? The Russell for the first time is overperforming. It's up almost 2% compared to even the S&Ps, which are up 1%, and the NASDAQ, which is up 0.5%, and then the Dow, which is /YM, is up 0.75%. Volatility is a big factor in all of the trades that we look at when we're selling premium, and you can see volatility in by $1.71, but still relatively elevated at 23.25, with the last 20-year average in volatility being 20. 23 is relatively high. So let's take a look at what we can find for something to trade today. You know that I like to look at my IV rank on the left-hand side here. Now that volatility has expanded over the last couple of days, we've got a lot more stocks that don't have earnings that have a relatively high implied volatility. You remember in the weeks prior to this week, we were looking at IV ranks that were quite low in the single digits. Now you've got 30s, 40s, and 50s. And one that sticks out to me is GLD. Now, when I came in this morning, I didn't think that volatility was going to be in by almost 7%, and that GLD would be down $2.70. But you know what? Sometimes you can't always pick the tops and the bottoms of a product. Now, if I would have looked at this 2 or 3 days ago when GLD was rallying up to 175, 178, I might have said, wow, this is a time to be a little bit of a contrarian. We've just had a monster rally in GLD, so maybe I'll put on an Omni Directional or a short position on here. But most importantly, take a look at what volatility is doing down here on the bottom. This is the IVR, that's the IV rank. That's the implied volatility of GLD. That's this monthly implied volatility here as measured by itself. So with an IV rank of 57, IV rank goes from 0 to 100. With IV rank of 57, it's relatively high in the top half of its quadrant. And you can see here how much volatility has expanded. It did the same thing when it signaled GLD rising here back in March. So maybe GLD is going to come sell off or maybe hang sideways. So what's a good strategy for something like that? Well, first you're looking at a stock that has good, not great markets, if you can believe that. Some markets in GLD will be 10 cents wide. Look at this, 425, 435. Let's look at, I'll change this to open interest. Look at the open interest here, 40,000, 2,000, 8,000, a couple of hundred in these single strikes because they're relatively new strikes. Remember, prior to expiration, which was last Friday, you had $5 wide strikes, the 180s, the 185s, the 190s. You didn't have the 189s, the 188s, and the 187s. That's why they're open interest is so much lower. It has nothing to do with pin risk or unusual option activity, which I think is just bullshit. But what are we going to take a look at here? Well, I told you I wanted to be a little bit of a contrarian, like a little bit of a downsided play. So you know me as a contrarian. That means I have to sell a call spread. I'm looking at being short an embedded naked call or being short an embedded call spread. Let me explain to you what I'm going to look to do. I'm going to look to buy one of the 187s. We typically go around the 30-ish delta option. You can pick whatever one you want. The real key is how close do you go with your two shorts that you have. The closer you go to your long strike, the more bearish you are. I'm going to go $3 wide. I'm going to go 187, 190, and I'm not going to sell just one of the 190s. I'm going to sell two of the 190s. Now, I was able to do this for $1.78 when gold was down around $2 $1.50. Now, you can see that trade by clicking on the follow page right here. And you can click on Bob the Trader IRA, and you'll notice that I have it here just a moment ago from when I made this video. I make these videos sometime between 10 and 11 a.m. Central Standard Time, and usually we get them out before noon that day to keep it as relevant as possible. You can see I got filled at $1.78. You can look at my pop; it's 82%. The IVR is 58, which I just showed you a moment ago. And then I put a little description on each one of my trades. Omnidirectional, slightly bearish ratio spread. So let's explain to you why it is a slightly bearish ratio spread. Well, we just looked. It does have an 82% pop. My extrinsic value is whatever credit I receive. Now, I told you the tighter you go towards your long strike, the more bearish you are. Because look what happens. My delta is short 21 where I have it. And as I go closer, I get more short. My delta is 26. As I go further out, my delta gets less. It's only short 13. Is this trade any worse or better than the trade I'm putting on? No, actually, this trade has a higher probability of profit. But you know what? You could make less money on the overall trade. Now, can you make less money on the overall trade? Look at what you really want here. With an expected move of $9 in GLD, you're looking at right around 189 or 190. That's right where my short strike is, right at the expected move at expiration, 59 days away from here in May. Now, look at this. If it goes right to 190, this 187 call I'm long one time will be worth $3. These 190 calls I'm short two times will be worth $0. I'll make $3 plus whatever credit I sold the spread for. Presently, it's $1.72. So you'd make $472 on the $2,800 in buying power that you're using. Now, I get a lot of comments on YouTube. How come your buying power is $2,800 and my buying power might be something like $17,000? Well, in Tasty Trade, you can sell naked call options like this spread. Maybe the brokerage firm you're at doesn't allow you, but you can at Tasty Trade. It just uses more buying power, and it might use $17,000 in buying power. Now, what would I do? I like to keep my IRA account very I don't know if it's not coherent. I guess that's not the right word. I like to make it match pretty much what a margin account would do. So what I might do in something like this is I might waste the $14 or $15 it cost me to buy this 230 call. And if I click on buying that 230 call, you'll see the buying power actually in a margin account goes higher to $3,500. But in an IRA account, it would be the same $3,500 because it's a defined risk trade. Now, that's just a quick little tip on showing you how you can use, instead of $17,000 to put on a trade, you can use $3,500 to put on a trade, and your Greeks are essentially the same, and it costs you $15 to do that. Now, for me, in a margin account, it doesn't make sense to do that, to put on that one. But you in an IRA account or a cash account or something, another brokerage firm that doesn't allow you to sell a naked call, and you have not moved your account to Tasty Trade, shame on you. But still, you could be able to do something like that. All right, I'm Tony the Bat Batista, and what would I like you to do now? No more shame. Open up your account at Tasty Trade. Take it, move it, whatever you have to do. Help us keep the lights on.